The biggest threat to OPEC Plus discipline right now is not political rebellion. It is physics and physical infrastructure. Sometimes a producer simply loses the physical ability to stop pumping. Inside the alliance, no country illustrates this better than Kazakhstan. They are OPEC Plus's largest and most persistent overproducer. This table breaks down Kazakhstan's production figures from March 2025. Look at the crude quota target set at 1.468 million barrels a day, then compare it to the actual output below it at 1.79 million, creating an overshoot of more than 300,000 barrels a day. This gap is not a one-month spike or a temporary act of defiance from the government in Astana. It is a persistent structural reality. The sheer persistence of this discrepancy exposes a core limitation in how the cartel manages global supply. Diplomatic agreements signed in Vienna cannot simply override physical machinery operating on the ground. To understand why this is happening, we have to isolate the true source of the overshoot. Kazakhstan's total liquid production actually reached roughly 2.08 million barrels a day, well beyond any crude limit. But OPEC Plus quotas strictly apply to crude oil. A large slice of Kazakhstan's headline production is condensate, a light liquid drawn from its gas-rich fields. If we subtract that non-quota liquid from the 2.08 million total, we are left with 1.79 million barrels of crude output. Even after stripping out that definitional artifact, a severe gap of over 300,000 barrels a day remains, protruding above the target line. When you split the country's remaining crude output by ownership structure, the true source of the excess becomes clear. You have smaller fields operated national state company on one side and mega projects operated by international consortiums on the other. More than two-thirds of Kazakhstan's total output is locked inside three foreign-operated giant fields, Tengiz, Kashagan, and Karachaganak. These fields run under production-sharing contracts signed in the 1990s, decades before OPEC Plus quotas existed. These binding legal agreements guarantee the foreign operator's economics and give the state virtually no power to legally mandate production cuts. This leaves the Energy Ministry with an impossible paradox. The government agreed to a binding international quota commitment on behalf of millions of barrels of oil it does not actually control. What turned this chronic accounting issue into a structural crisis for the cartel was a single event in January 2025. The completion of the Tengiz Future Growth Project. This was a Chevron-led expansion costing roughly $50 billion, and its completion injected an additional 260,000 barrels a day of new capacity into the market. This single mega project breaks the country's quota arithmetic entirely. Tengiz alone now pumps near 1.0 million barrels a day. That one field consumes nearly the entire national crude allowance. The reason the operators refuse to scale back comes down to the economic law of sunk capital. When a company sinks $50 billion into new infrastructure, its only rational fiduciary incentive is to run that capacity flat out to recover the investment. When the Energy Ministry approached Chevron about enforcing the quota, the company's response was blunt. Idling their new asset to satisfy a quota they never signed was economically not possible. The pressure is only compounding. The offshore Kashagan platform is actively ramping up its own gas processing capacity, which will pull its output even higher. In modern energy deal-making, the physical reality of a massive capital asset and decades-old contract law will always overpower a monthly diplomatic target. OPEC Plus attempts to police this kind of rule-breaking from what it calls compensation schedules. A member that pumps too much is required to make deeper cuts in later months to pay back the excess barrels. Look at Kazakhstan's current standing on this chart. They carry the alliance's largest cumulative compensation burden, with required cuts scheduled to climb steeply through 2026, while their actual physical capacity trends steadily upward. Because of this widening divergence, analysts universally view this payback schedule as purely aspirational, rather than a functional plan that can be executed. To honor the debt, Kazakhstan would have to force operators to idle the exact megaprojects they just spent billions of dollars to expand. This creates a quiet tension in Vienna. The cartel's credibility relies on members honoring their commitments. Yet its largest overproducer is legally and structurally incapable of doing so, and everyone at the table knows it. When the rulebook dictates actions that are physically impossible to execute on the ground, the alliance is forced to rewrite its strategy. Faced with an overproducer it cannot discipline barrel by barrel, the broader group, led by Saudi Arabia, has chosen a different route. Through 2025 and 2026, OPEC Plus shifted away from defending high oil prices with deep cuts, pivoting instead to unwinding voluntary reductions, adding supply back into the market in measured steps. The economic logic here is straightforward. If overproduction is going to happen anyway, allowing more official supply competes away the financial premium that disciplined members were effectively handing to the undisciplined ones. The immediate cost of this strategy is price. As the alliance adds barrels and non-OPEC supply from the United States and Brazil keeps growing, oil prices soften across the board. It is a blunt instrument that pressures every producer's revenue, but it stops the bleeding of market share from members who follow the rules to those who break them. OPEC Plus has chosen to weaponize its own supply and accept lower prices rather than rely on compensation schedules that have proven to be entirely fictional. The pressure now converges on a looming point on the horizon for the entire group, the 2027 baseline reckoning. A reference baseline is the foundational production level from which all of a country's future percentage cuts and quotas are calculated. Heading into these negotiations, capacity-rich members like Kazakhstan and the UAE will aggressively argue for higher reference levels that accurately reflect the massive physical billion-dollar infrastructure they have already built. The expected outcome here is not strict compliance. OPEC Plus is highly likely to offer accommodation, granting higher baselines to legitimize the barrels that are already flowing. For global markets, this points to a structurally better supplied world, where more physical barrels reliably reach buyers than the official quota tables suggest. This impending renegotiation quietly confirms a major shift in cartel power dynamics. Physical capacity now dictates the quota, rather than the quota constraining capacity. For energy suppliers, B2B vendors, and service companies, this unyielding production reality offers a distinct roadmap. Kazakhstan's persistent overshoot is not a bureaucratic accident. It is a direct symptom of massive, committed capital sitting in megaprojects like Tengiz. The operational reality of these assets is that they must be actively maintained, serviced, and operated at peak capacity for decades to come, remaining completely detached from the extreme volatility of global market fluctuations. Selling into this sector requires looking past the monthly political communiques from OPEC Plus and focusing squarely on where the hard capital has been deployed. Suppliers must understand the operator's economics. A facility built to run flat out will consistently buy the goods and services necessary to sustain that physical momentum. In the ongoing standoff between international quota treaties and $50 billion of sunk capital, the capital secures the physical barrel, and that is where the true market opportunity lies.